There are multiple different styles that alter your decisions when trading. Choosing a consistent style that matches with your expectations is a difficult search for a beginner trader. It often adds to their frustration and disillusionment when investing in cryptocurrencies. However, it doesn't have to be this way. My name is Josh, and today we'll learn about the 4 styles of trading. After this video, the only thing that you have to do is figure out how much time you want to attribute to your trades, when you want to see returns, and what margins you're aiming for. You can establish a coherent way of managing risks that yields far more successful investments over time. You'll master your style and avoid getting caught off guard. The trading style we will talk about first is called scalping. It is a form of intraday trading, which means that investors known as scalpers execute trades in a very short term, typically never leaving any positions open at the end of the day. Timeframes for scalpers will be from as short as 1 to 5 minutes to 2 hours. With an impatient hand, scalpers are therefore constantly on the lookout for entry and exit opportunities and are reacting to small price movements. This trading style is not for the faint-hearted and will keep you on your toes every day. Scalping traders could make hundreds of buys and sells in a single day. They share the belief that acting on minor price changes is more fruitful than interpreting weekly or monthly market trends. By making small gains on each position, their ultimate goal is to benefit from racking in and building up compounding earnings. One of the main upsides of this style is that due to the small margin targets, you can fight your greed instincts and never get emotionally attached to your trades. Before moving on, this could give you a real edge in crypto investing. Scalp traders rely religiously on careful risk management, as they have to uphold a win-loss trading ratio, which is significantly over 50%. Given the high number of trades with comparable short-term profits or losses, overall earnings would otherwise equalize and leave scalpers empty-handed. They therefore have to be right the majority of the time. An extra factor to the scalping equation are transaction fees on the exchange. With hundreds of fast-paced trades every day, aggregated fees quickly stack up and diminish returns. Secondly is day trading, which is, in many regards, similar to scalping. The main difference typically lies with higher targeted profit margins and longer periods for keeping positions open. Whilst scalpers will try to buy and sell within minutes, day traders may wait for several hours over the course of a day. You would generally not keep any positions open longer than 24 hours when using this trading strategy. Day traders, likewise, work consistently with technical analysis and stop losses to scale in and out of positions. However, depending on the trader, he or she may pay some weight to intraday market trends or other external factors. Next up is swing trading. It involves trying to identify market trends. You would usually do this by opening positions for a couple of days, 2 weeks, or even months. Unlike scalping, it requires patience. Swing traders attempt to follow intermediate-term market developments. They benefit from volatile conditions because they look for higher potential profit margins. The crypto market is therefore a fruitful environment, since it creates a high number of these investment opportunities. The benefits of swing trading are that it has a comparatively low stress level, can be done in your spare time, and has low brokerage costs, since only a few trades are executed. This makes it a suitable place to start for beginners. And finally, position trading. This is the strategy with the longest outlook for investing. It's like a bird's eye view of swing trading and may imply a great deal of holding your assets. You would usually sell positions only after several months or even years. Convinced that the real profits come in the long haul, it requires a solid basis of preliminary research to perfect your fundamental analysis. When done correctly and combined effectively with technical analysis, you can take home the chunkiest margins. As a position trader, you should keep a cold head and ignore intraday fluctuations, trusting fully in your evaluation of weekly and monthly price charts. I hope that after hearing about these strategies and their considerations, that you can now log into your Cryptohopper account and implement the trading strategy that you find most appealing. The key takeaways is that the style of risk management is at the heart of the distinction. This means that if you aim to make a high number of trades, your positions will become smaller and your stops tighter. Continuity is something many new traders struggle with, as they find themselves distracted by herd mentality and the omnipresent media noise. If you can avoid letting this interfere with your chosen style, you are on the road for long-term success. A few weeks ago, I actually read a nice blog that goes deeper into scalping Bitcoin that might interest you after watching this video. I'll leave the link down in the description. Also, don't forget to leave a like on the video and click the subscribe button. We'll see you next time.